to get started. So welcome everyone. Thank you so much for joining us today for our Manufacturing Playbook webinar on tax, tech, and transformation opportunities. My name is Sarah Mills. I'm the Vice President of Government Affairs at AIM, and I'll be moderating for today's event. We're thrilled to be partnering today with Citrin Cooperman to bring you this program. Today's discussion is all about helping manufacturers navigate this rapidly changing environment, from tax incentives, digital transformation, to warehouse expansion opportunities. This webinar is focused on these recent changes passed on the federal level, but as someone in the government affairs team at AIM, I just wanted to give you sort of a brief update of what's going on with our work and how we're also trying to support our manufacturing community. We continue to advocate at the state level, working on policies that make it easier to do business in Massachusetts, especially when businesses are facing high costs in the state, including the cost of energy. And I bring that up because as we near the first year of our legislative session, something that's coming up quickly is the sort of a large bill to address energy affordability here in the state. And we're thinking a bill might be taken up at least by the House chamber in the next few weeks. And as we continue to work with our members, a lot of you that are on the call to understand what some long-term solutions are that we can come up with to increase supply, we're also taking a hard look at other things like the Mass Save program to help advocate for reforms that make it less burdensome for ratepayers. And we think this is critically important for all of our members, but of course our manufacturing community, in particular, being some of the biggest ratepayers that we have in the state. And I'm just flagging this because my colleague right now is holding a meeting with the administration who filed this bill, and something we'll be working on very, very soon and for the rest of the legislative session. I just wanted to flag that. So should folks on this call be interested, we're always happy to talk about that piece of legislation and all the other work that we're doing here on the government affairs team to support our manufacturers. Before we get started, I wanted to do some quick housekeeping. As you've probably noticed, as you joined, attendee cameras and microphones are off and will remain so throughout the session. However, we do have our Q&A function open, so please feel free to send in your questions at any point throughout the panel discussion. We're going to try to weave in those questions throughout the discussion when possible. And if we don't get to them, we'll try to get to them at the end of the panel conversation, or we'll make sure to follow up afterwards and get you your answers. Finally, this webinar is being recorded, and so we plan to share this with participants afterwards, as well as any sort of supplemental materials that might be helpful after the event is over. So with that, I would like to help kick things off, I'm going to introduce Leslie Grice, co-chair of AIM's manufacturing community and owner of Kinafac Corporation. She's a huge advocate in this space, helps us a ton with our policy work. So Leslie, thank you for joining us, and the floor is yours.
Okay, thank you, Sarah. And greetings to all the manufacturers here today. And thank you very much for attending this AIM Manufacturing Community webinar. As Sarah said, my name is Leslie Grice. I'm from Kinafac Corporation. We're based in Worcester, and we make precision metal forming machinery, which is sold to the automotive, aerospace, medical device, and power generation industries around the world. I did see the attendance list. I see companies on the Zoom today that really represent a variety of manufacturers in the state. And many of you participated in some of our manufacturing community activities before. As Sarah said, I'm privileged to co-chair the manufacturing group along with Mike Keneally from Accutech, who unfortunately is unable to be here today, but sends his regards to all. Our AIM member manufacturers come together through events like this to learn from each other and to create a stronger voice at the table for our specific issues and to help each other be successful. As we all know, running a manufacturing company is not easy. We face competitive challenges from other states, other countries. We work in a high-cost environment, and qualified labor is hard to find. We need to stay current, continue to improve our capabilities, our technology. So the AIM Manufacturing Group has been focusing on helping our fellow manufacturers with some of these competitive issues. As one example, very recently, the AIM manufacturing community met with the Mass Legislative Manufacturing Caucus on Beacon Hill, and we've created a close relationship, a productive one, with Representative Roy and Senator Feeney, the co-chairs of the caucus. And these joint efforts have helped increase Beacon Hill's understanding of our manufacturers' needs and issues, and increase visibility of the contributions of our manufacturing community to the state economy. Please consider being part of our strong network and attend future manufacturing events and help us strengthen our voice. Now to today's program. As we all know, running a manufacturing plant means dealing with daily challenges. It seems like we're always on defense. But I'm pleased to say we have experts from Citrin Cooperman here who will give us ways to play offense and to improve our bottom line. So I'm going to turn the program back to Sarah to get the jam-packed program event going and to start the panel discussion. Thanks.
Great. Thank you so much, Leslie. Always appreciate your perspective and your participation. Again, really lucky to have you. And we'd love for you to stay on camera as we move into the panel discussion to provide some commentary. You can bring your perspective as a manufacturer and as your in your role as co-chair. So now, as Leslie said, we're going to meet our panelists and get right into the program. So we're joined by 3 experts from Citrin Cooperman, each bringing a unique perspective on how manufacturers can leverage tax, technology, and transformation opportunities to strengthen their businesses. First, we have Bob Alperin, Partner and Federal Credits and Incentives Leader at Citrin Cooperman, Peter Emmerling, Director of Digital Transformation at Citrin Cooperman, and Laura Jenkins, Tax Partner. Thank you all for being here. So let's just get right into it. Laura, I'm going to start with you. Can you start us off by walking through some of the key tax law changes manufacturers should know about under the recent One Big Beautiful Bill Act, or what I will likely refer to as OB3 just for efficiency purposes? Go ahead, Laura.
Yes, that's a big question to start off with. So just to give like a brief history lesson as I dive into this, because so much of what was in the One Big Beautiful Bill are actually corrections or extensions of prior tax law, namely what came about through the Tax Cuts and Jobs Act, or what we'll call the TCJA. So just to kind of give the overview, I think a lot of people are probably familiar with this at this point because it's been several years, but the Tax Cuts and Jobs Act created a lot of tax provisions back at the end of 2017, which was Trump's first administration. And there were a lot of taxpayer favorable items in that bill that we have all been taking advantage of and have grown very used to over the last several years. But most of those favorable provisions were set to expire at the end of either 2025 or 2026, depending on the provision. And so what a lot of the One Big Beautiful Bill did is either permanently extend or temporarily extend some of those favorable items, which is what I'm going to focus on. There's definitely some new stuff in there too that we'll talk about, but a lot of what I'm going to go over may be familiar to you. But why it's such a big deal is that had those items expired, we would have gone back to a very unfavorable landscape that we wouldn't want to revert it back to. So I think the first thing to focus on was the extension, and it was made permanent, the qualified business deduction. And so many manufacturers are able to take advantage of that. It's for all taxpayers, all entities other than C corporations that are operating domestically. Their flow-through income or income of sole proprietors was only being taxed at 80%. So you were able to receive a 20% deduction off of the income of the business, this qualified business income deduction, which brought if you're an individual with a top tax rate of 37%, but you're only being taxed on 80% of the income by way of this deduction, it brought your effective tax rate down to 29.6%. So that's a huge deal. And that was set to expire at the end of 2025. And that was going to be extremely detrimental. Along with that, the top individual rate was set to go from 37% back up to 39.6%, which is what it was prior to the TCJA. So if those two items had expired, we would have gone from an effective rate of 29.6%, which is what we've all been used to for the past 8 years, to 39.6% at the federal level. So just, a huge hit. So while it's not anything new in the One Big Beautiful Bill for those items, it allows us to kind of permanently retain the status quo that we've gotten used to and not had to worry about that 10% hit that was coming. So I think those were huge items in the bill. Similarly, there are some depreciation provisions that I'm going to get into more detail later, so I'll just talk briefly. with bonus depreciation and Section 179 expensing, that those were phasing out and set to expire again as part of the TCJA, and the One Big Beautiful Bill kind of brought those back in a huge way. A couple other things I want to touch on. Section 163J. This is another TCJA item that was established as part of the TCJA. And what that is interest expense limitation. So for certain large businesses that have, a high amount of interest expense, especially I'm thinking PE-backed businesses and such that are highly leveraged, starting with the TCJA, those businesses are only able to deduct interest expense up to 30% of their adjusted taxable income. I don't want to get too technical on what adjusted taxable income is, but when this bill first came out, adjusted taxable income was more or less defined as EBITDA. So you'd take your taxable income, but then you would add back your depreciation expense, amortization expense, interest expense, and you would take that number, let's say it's $1 million, and you could only deduct in interest 30% of that. So if you have $1 million of adjusted taxable income, you can only deduct $300,000 of interest expense for that year. But starting in 2022, they changed the definition of adjusted taxable income, and you were no longer able to add back depreciation and amortization. So for manufacturers, especially who tend to have large depreciation and amortization expenditures, that really hit them on this 163J limitation, where now they are only able to deduct 30% of their taxable income without those depreciation and amortization add backs. So the One Big Beautiful Bill kind of reverted the definition of adjusted taxable income back to EBITDA, which definitely helps out manufacturing companies and allows them to expense more interest. I will point out, this is nothing new with the 163J. Any interest you weren't able to deduct in the current year because of that limitation would carry forward, and so you would eventually get to deduct it when you had high enough adjusted taxable income in a future year. So you didn't lose it permanently, but that was a big limitation that came in as part of the TCJA that people had to get used to, and then further losing the depreciation amortization add back benefit hurt a lot of companies. So it's great to see that came back. There's so much in the bill, so I know I've been rambling for a while. I'm just going to touch on like 2 more things for now, and certainly I'm sure some other stuff will come up as we keep talking. But one that I think the manufacturing companies will see and need to be aware of is that this no tax on overtime. So the reason I point that out for manufacturing companies specifically, if you have a lot of hourly employees that are earning overtime, it's going to be required starting in 2025 that overtime be separately stated on the Form W-2 so that employees are able to do the calculations on how much of their overtime they are able to exclude from their income. The payroll companies are all over this, so hopefully your payroll company has already reached out to you about this, but it is a 2025 item. It's not, it's retroactive to the beginning of 25. So as we're getting ready to do W-2 reporting in a couple of months, that needs to be on there. And then the last thing I'll mention for now is the estate and gift limit. So again, prior to the TCJA, the estate limit for an individual, the amount that they could gift or leave to their heirs in their lifetime before it was subject to estate tax was $5 million, and that was going to be indexed for inflation. It did get increased to $10 million and indexed for inflation. And so I think last year it was in the $13 million range. And at the end of 2025, that was set to revert back down to the $5 million number, which again, it would have been adjusted for inflation, but losing a big chunk, and that's an individual limit. So for a married couple, you would get twice that amount. The One Big Beautiful Bill permanently raised that limit to $15 million per individual, so $30 million for a married couple, which is a lot different than $10 million for a married couple that we were going to revert back down to. And that number will continue to be indexed for inflation going forward as well. So it'll continue to grow. So
Great, thank you.
a lot there.
As you said, a large bill, a lot to go through. So really appreciate that we have you here to be able to sort of walk us through that. I know you mentioned the Section 179 and bonus depreciation. Before we move on to the next panelist, can you share how these provisions are impacting business strategies and behaviors among the manufacturing community especially?
Yeah, I mean, so I'll give a little more of an overview on what was happening there. So I think there was a lot of interplay and planning going on with capital additions in the past few years because bonus depreciation was phasing out. So bonus depreciation, probably everyone knows what that is, but for capital additions placed into service, with the exception of, non-residential real estate, buildings and the like, taxpayers were, for a long time, were able to 100% deduct that item in the year they placed it in service for tax purposes, instead of having to depreciate over 5 years, 7 years, 15 years, whatever the useful life is. And that had been around for a long time and was kind of like status quo. But the TCJA was actually phasing that out. So beginning in 2022, bonus depreciation, it was 100%, and then it was phasing down 20% each year, and it was eventually supposed to go away completely. And so in 2023, you would only be able to get 80% of or you were only able to get 80% of the cost expensed in the first year. In 2024, it was 60%. In 2025, it was 40%. Then it would have gone to 20%. And then eventually no bonus depreciation. We'd be back to regular, 5-year, 7-year depreciation. The One Big Beautiful Bill reinstated and made permanent the 100% bonus depreciation. So for, again, all property aside from non-residential real property, and I'll put an asterisk there and I'll come back to that. But you're able to 100% deduct that again now in the first year. And that was retroactive to January 19th of 2025. For assets placed in service starting January 19th of 2025, we have 100% bonus depreciation back. So businesses were kind of timing, when is it going to make sense for me to place this into service? I might want to get it into service as soon as possible because the bonus depreciation is continuing to phase down. Now it's back to 100%. There was also the interplay with the depreciation and amortization add back for 163J that I was talking about, where, you weren't going to get the benefit of that, but now that's back. So I think, that's a big tax planning strategy for businesses to be able to, any of your capital additions that you're placing into service, you're going to be able to get the tax benefit of 100% writing it off in year one. And then on the flip side, you can add that back when you're doing your interest expense calculation. And then just quickly, Section 179 is a similar provision to bonus depreciation. If you elect Section 179 on your capital additions, you also get to 100% expense those items in the year you place them in service. But there have always been limitations on 179. The limitations currently before One Big Beautiful Bill were you could only elect 179 on $1 million of assets placed in service in a given year. So for larger businesses that, may not have been a large enough limit. And similarly, if you placed more than $2.5 million of assets into service in the year, then your 179 limitation, that $1 million, would start to phase down. So if you're a large manufacturing company and you have $10 million of capital assets that you're placing in service in the year, or even $4 million of capital assets you're placing into service during the year, you wouldn't be able to take advantage of Section 179. Why we like Section 179? A lot of the states conform to it. And so if you get a 179 expense at the federal level, you in Massachusetts would also get that at the state level, whereas bonus depreciation, the states don't conform to that. You have to kind of depreciate over the normal 5-year. So One Big Beautiful Bill increased the 179 limits from $1 million to $2.5 million. And then that total asset limitation went from $2.5 million. So if you had more than $2.5 million of ads in a year, you would start to lose your 179 availability. And they increased that to $4 million. And both of those will also be adjusted for inflation going forward. So it just opens up that expense opportunity for a lot more companies as well.
Laura, just at the Precision Machinists annual meeting, and they said that less than half of the companies are actually in corporate form of ownership, and most are subchapter S or something else. And is the new bill favorable to both forms of ownership, or where is it different, say, for a sub S corporation?
It's definitely favorable to both, in my opinion. I guess, again, back to my history lesson, the TCJA lowered the corporate rate for C corporations from 35% to 21% back in 2017. And that was made permanent then. So that wasn't on the chopping block here. So corporations had that nice 21% rate, and they were sitting pretty with that. These depreciation provisions impacted them negatively. The 163J impacted them negatively, but they had their rate. But the sub S corporations, the partnerships, the sole proprietors, they were dealing with that impending 10% increase to the rate that I was talking about because of losing QBI and losing just the individual rate was set to go back up. So they were also being negatively impacted by, the depreciation, the 163J, just like the C corporations, but they were going to have that 10% rate hit as well. So the One Big Beautiful Bill, I think, might have been slightly more favorable for the sub S and the partnerships, like you said, just because of that fix being put in. But I think the other provisions help both similarly.
Great. Thank you. And thank you, Leslie, for raising that question. All right, let's turn to Bob now. We're going to turn to R&D, which we know is always a hot topic in manufacturing. So can you talk to us about how the One Big Beautiful Bill and the changes in it affect businesses incurring research and development expenses?
Sure. Sounds good, Sarah. So first I'll touch on how it impacts businesses for 2025, and then we can talk about how it impacts businesses maybe for years prior to 2025. So, Laura mentioned that, the TCJA had some very favorable tax provisions, but it also had some very unfavorable tax provisions. And one of those provisions under the TCJA was that R&D expenses that were previously businesses were able to previously currently deduct, beginning in 2022, those costs R&D costs needed to be capitalized and amortized. And if they were domestic R&D costs that are performed in the US, they'd be capitalized and amortized over 60 months, 5 years. And if they were foreign R&D costs, they'd be capitalized and amortized over 15 years, right? So pretty big penalty, effectively, for doing research outside the US. So under the OBBBA, there were some very favorable changes related to R&D. And so for tax years beginning on or after December 31st, 2024, all businesses are now able to currently deduct domestic R&D expenses. So we're basically back to where we were pre-2022, pre-TCJA. However, foreign R&D expenses still need to be capitalized and amortized over the 15 years. Okay, so there's still that penalty. One of the other very favorable changes is that businesses that did capitalize R&D costs from 2022 through 2024, the domestic R&D costs, the unamortized amount as of January 1st for a calendar year taxpayer, as of January 1st, 2025, that unamortized balance of previously capitalized domestic R&D costs can be currently deducted in 2025. So taxpayers, could have a very favorable tax deduction in 2025, or there's also the option to spread it evenly over the first 2 years or first 2 tax periods after December 31st, 2024. So calendar year taxpayer, instead of deducting all those previously capitalized costs in 2025, they could spread it over 25 and 2026. Some other opportunities that are out there for 2025. Some taxpayers may not want to currently deduct R&D costs. Maybe they're in a loss position and they want to preserve their NOLs. So maybe they want to continue to capitalize costs. And there's still that option one option is to capitalize your R&D costs, domestic R&D costs, over 60 months, 5 years, and you begin amortization in the year that you start generating benefits from that R&D. And another option is the old Section 59E, which allows taxpayers to capitalize and amortize R&D costs over 10 years. And you would begin amortization in the year that the costs are incurred. So you don't have to wait until you start generating benefits. So there's a lot of planning opportunities, a lot of modeling that needs to be done related to 2025 and after.
Great, thank you. And so you're talking about 2025 and moving forward. Are there any tax law changes under the bill that enable businesses to retroactively deduct the R&D expenses that were capitalized between 2022 and 2024? So if we're thinking in the past instead of in the future.
Yeah, absolutely. So there are some special rules that relate to qualified small businesses. And a qualified small business is a business that has average gross receipts from effectively 2022 through 2024 of less than $31 million. Okay. So if you have average gross receipts of less than 31 million, and there's a definition of gross receipts are and so forth, then you're a qualified small business. If you're a qualified small business and you capitalized R&D costs, let's say in 22, 23, 24, you are able to go back and make an election to retroactively apply these new rules. So for many taxpayers, we just got through corporate tax filing season for a lot of our calendar year end taxpayers. So a lot of qualified small businesses that would have been required to capitalize R&D costs in 2024 actually went ahead and were able to make it either a deemed election with the 2024 return to deduct the domestic R&D costs currently, and these rules only apply to the domestic R&D costs, or they could simply make an election with the 2024 return to deduct those costs currently. However, if a company does that, if a business did that for 2024, then they're also required to do it for the other years where they capitalize costs. So they would be required to file amended returns for 2022 and 2023. Okay. There is another option. Instead of making that retroactive change, a company could make a retroactive accounting method change. And the way that a qualified small business would do that is they would file a accounting method change with the 2024 return and basically electing to deduct the costs currently, domestic R&D costs currently. And then that would be retroactive to 2022 and 2023. In those years where they capitalize those costs, you would go back, deduct those costs, have a favorable, we call it a 401A adjustment in 2024. So they get a nice benefit in 2024. So definitely opportunities for qualified small businesses to do that. A lot of qualified small businesses did take advantage of that. And there still is an opportunity to take advantage of that. You can file amended returns as long as they're filed by July 6th of 2026, basically 1 year from the date that OBBBA was signed into law.
Great. Thank you so much. Always appreciate highlighting things, especially for our small businesses. Leslie, please.
Yeah, Bob, that was great. Looks like our manufacturers are going to need some expert help here, because the thing that strikes me is that there are a lot of options, and that means choices And then
Yes.
usually when I'm approaching year end, I'm thinking, gee, do I make that extra purchase before December 31st? It's going to help, it's going to hurt. But it sounds like a lot of the new regulations are retroactive. So it's not as much that decision about whether you sneak it in December or January, because you're going to get probably favorable treatment anyway. Is that a fair enough? Is that a fair statement?
That is, so in terms of R&D, if you have a big, R&D expense that, you expect that's going to hit toward the end of 2025, and maybe in the past you were thinking, well, geez, maybe we should defer that until 2026, or maybe we want to accelerate it into 2025. If you're looking for current deductions, right, then you want to take that expense in 2025, right? Versus, let's say you're a company with in an NOL position and you have expiring NOLs and you're trying to push deductions out, then you could start thinking about those capitalization rules, or in your example, pushing that expense out till 2026.
Great. Thanks, Bob. Appreciate it. Okay, now we're going to shift again. So we're going to shift into technology and the tech opportunities. So Pete, I'm going to stay with you for the next couple of questions. So artificial intelligence, it's here and it's rapidly evolving. So how is AI currently being used in finance and operations functions, and what benefits have you seen that you can highlight for the folks on this call?
Yeah, thanks, Sarah. I appreciate the question. AI is on everybody's minds today. It's a common topic of conversation. I went back to our 2025 manufacturing pulse survey that Citrin Cooperman presents, where we had 500 folks across the manufacturing industry participate. It was interesting. 69% of the leaders said that AI has impacted their business, in the past 3 years, but really only 7% have mature adoption of that. And I think largely that's because of the speed at which AI is moving and evolving. And so oftentimes when we talk about AI, I kind of like to classify, how to think about AI. There are many different categorizations and classifications, but the way I think about it in the simplest form are kind of 3 different levels of AI. You have your sort of what I call like a personal assistant or agent, your desktop AI, your co-pilots, your chat GPTs, your Claude AIs of the world, right? And a lot of that is helping us get work done, whether it's reviewing a document and getting insight, helping us write an email, being able to give you insight into your week ahead or week past. And then there's, embedded AI. So this AI technology is embedded in software. So your ERP system may have AI components to it where you're able to query certain elements of that system, or there's certain automation components, all the way down to your manufacturing execution system and your robotics, right? You may have embedded AI within them. And then there's a third category, which I think about as more of enterprise AI. And really what that is more about is like being able to gather your organization as a whole and being able to leverage AI to query that data, to get insights into your organization, as well as highlight, predictive elements of your organization. And to get into that enterprise AI, you really have to have your data in order. You have to have your systems connected and integrated, and you have to be able to extract that data. So oftentimes, as we kind of think about those 3 different levels, it becomes more difficult as you go up that chain to leverage AI because of the investments that are required for you to be able to achieve those. But they certainly each have their own benefits and capabilities. When I think about finance and operations, I go back to the traditional finance components of core processes. So let's think about procure to pay, and a lot of this technology has been around for some time. We think about AP invoice processing, so being able to pick up an invoice as it comes through into your organization, read it, pick up elements of it, validate it back to your ERP system, and then automatically code it. So really minimizing a lot of the work that has to happen on a manual basis to be able to process those invoices. And of course, when you think about procure to pay, you think about the volume of invoices that an organization may have, ranging from 5,000 plus a year. It's a lot of time and effort. And of course, there's a lot of opportunity for error. Other areas within finance, I think about AI is really around thinking about, closing your books and producing reporting. So AI is great about looking at your accounting entries, looking for anomalies from a financial perspective where things may look off from one month to the next or one period to the next, and helping you identify, where those are and drilling into those and really drawing your attention to them. So there's a reconciliation aspect of AI that's really impactful. But then I think about the financial reporting piece, and it's not so much pulling the numbers together, but more so deciphering them. So AI really does a great job in certain instances around being able to analyze financials, analyze historical trends, and then be able to produce narratives and other contexts that allows you and leaders of your organization to pull the different levers they need to make as they make decisions within the business. And then a third component I think of it within finance is really around the predictive analytics. And so, in that aspect, it's everything from your annual budgeting and forecasting process, right? Getting a vision set for how you're going to operate your organization, down to how do you roll that forward, and how do you look at cash flow and cost forecasting, and looking at the different elements that impact that. And so, the power of these solutions allows that analysis to happen much more faster, and without as much effort to be able to get into, hey, where do we need to look at how we manage the business going forward? From an operations standpoint, there's a couple different ways that I think about it. Obviously production is one of the biggest challenges, thinking through production scheduling, ensuring that we have our supplies on time and enabled, and then obviously actually producing our products. And so, AI embedded in advanced MRP engines allow these tool sets to really crunch through that data, crunch through historical trends, as well as looking at sort of, what your demand is, right? So what's your historical sales? What's your real-time inputs? And then what are some of your external factors like tariffs, weather, economic indicators that might help you understand what that's going to look like in the future? And I think that's a really powerful use case for AI. We've seen, companies improve their forecasts by up to 20% or more. And, some of the benefits of that are reducing your stockouts, reducing excess inventory, and really getting your production environment to run, and hum along more seamlessly. In other areas, I think about is, above and beyond that, is looking at how we manage our inventory as a whole. So obviously production planning feeds into inventory, but optimizing the inventory on hand, making sure that we're able to meet the allocation needs of our customers. And so some aspect of that is, being able to dynamically run scenarios around, well, what happens if we have a disruption in our supply chain? What happens if we hit with a tariff that's going to change our costing? And being able to model that out in a way that allows us to look at where the failure points are within our supply chain and operations. I think outside of that, I think looking at how we leverage this across the organization is really being able to bring all those things together. And it really depends on your organization, right, and where you are in your life cycle and the way you operate your business. Does your manufacturing execution system have capabilities, the sensors, the inputs that are able to be leveraged for AI to process that data? Another good use case we see is, on the quality control, right? So having visual quality control and computer vision to what you're producing and anomaly detection. And so that it's taking, some of that human error risk out of the way, and then leveraging the data and the sensors and inputs to be able to manage that process.
Great, thank you. So you've highlighted a lot of ways that AI can be beneficial, and you've highlighted the very many forms that it can take. So as a follow-up to that, what advice would you give organizations that are just starting this AI journey? You said only 7% are really taking advantage of this. And so how can you help manufacturers help their teams adapt and get comfortable with AI technology, especially as you mentioned, it's rapidly changing all the time? So what are some strategies that you would advise?
Yeah, it reminds me of kind of 7 to 10 years ago when robotic process automation came out and everybody wanted to use it. And we often saw a sprawl of RPA use cases across the organization. And a lot of organizations struggled to get the return on investment of RPA. AI is somewhat of an evolution of RPA, and it has the same characteristics in the sense that everybody wants to use it and everybody wants to come up with a use case that benefits their particular area. And so in a lot of organizations, we see people, trying use cases, trying different tool sets that may not necessarily be approved by the organization, which is a risk, right? And ultimately kind of running in multiple different directions. So I think when you're an organization that's just getting started, or you're kind of walking down this path of AI, one of my first recommendations is building an AI task force. And that AI task force is usually representatives of individuals across the organization that can bring their individual perspectives of what their part of the organization needs. That task force helps organize the different use cases and the prioritization of those use cases on one element. And then on another element is kind of the tool sets that are being used and how they're going to be used within the organization. And so I find having that governance structure is important because it does mitigate some of the risk with folks using different tool sets. If you think about just on the risk point, like you're uploading sensitive data into these systems, contracts, sometimes other types of sort of privileged information. So you really want to keep that close. And so as part of that task force, I always think about starting small and focused, right? So look at a couple of those use cases across the organization, start building out test cases for them and work through them, right? And build success with them and start communicating that out to the organization. I think for a lot of people, they hear AI and the first thing they think about is, okay, I'm going to lose my job to AI. And that is a big, real concern for a lot of folks. And, it's really more about changing and reframing their focus about AI is there to help you. It's your assistant. It's going to help you do more with less effort in some respects, but it's also going to give you better visibility into things that you don't have time to look at. And so, getting a culture that is, willing to adopt AI and understand that they can be part of that process by participating in the evaluation of those use cases.
So Peter, if I could just interject,
Yeah.
You brought up use case would be, the accounts payable system you described. Manufacturers are always making a resource allocation decision. They're making buy or build decisions internally. So, if you want to apply AI to your accounts payable, is this a buy it or build it?
Yeah, that's a great question. Specifically to AP or procure to pay, it's, with the systems that are out there, it's a very mature market. So 9 times out of 10, it's worth buying it. Other areas of your organization, there may not be a solution available for that use case. So then in that case, it's more about building it. And I think the interesting thing is building it depends on what the use case is, right? Sometimes building it is just a process. So how do you go through about using your AI assistance to process a certain process step, right? And what are the prompts you're using? What are you going to do with the outputs? And how do you ensure that the outputs are valid, right? In other instances, it's much more automation driven. And so in that case, you are building components that have to be set up and defined and really architected. So it really depends on the use case. But for the procure to pay, I often recommend, buying versus building.
Great, thank you so much. One more quick question on the sort of AI front that we got, and then we can move on to sort of our last topic. Oh, there go my lights. Apologies, folks. My lights have been turning off all around me. So when we think about AI, I think a lot of people have concerns around cybersecurity risks with AI adoption. So can you just talk a little bit about that and how businesses can make sure their operations continue to run smoothly?
Yeah. I think that a couple of things, having that AI task force, usually what I recommend for our clients is to build a policy on AI usage and ensure that employees are made aware of that. Non-compliance is a huge risk for an organization, as like I mentioned before, about exposing sensitive data out into the world through these tool sets. So that's one aspect of it. Another is really kind of making sure that we have good cybersecurity training. People need to be aware of the importance of cybersecurity within the organization. And then obviously as supporting that is, having good processes that test that. So whether it's penetration testing, whether it's, leveraging role-based access controls and multi-factor authentication, being able to protect against folks from using unauthorized systems, and also protecting from unauthorized folks from accessing your systems. So those are other considerations that I would make. And then there are certain tool sets available out there from a technology perspective to help manage that. So there are sort of shadow AI detection type tools that look at usage behavior, and looking at what tools are being used in the organization that would maybe being used without approval.
Great, thank you. Really appreciate that overview. I think the conversation on AI will continue to evolve the way AI continues to evolve.
Definitely
So
will.
appreciate your perspective. Okay, so let's finally turn to one other major area of investment, which is facilities. And so we're going to go back to you, Laura. The new tax bill has a provision allowing companies to expense a building, which sounds like a big deal. So can you unpack how that might work in practice for manufacturers?
Yeah, absolutely. Good question. So this is the asterisk that I mentioned earlier when I was talking about bonus depreciation, where I said that, bonus depreciation typically only applies to tangible property, not including non-residential real property. But so this new provision in the One Big Beautiful Bill is for qualified production property. And the ability to take 100% bonus depreciation on qualified production property that's placed in service between January 19th of 2025 and January 1st of 2029. And what qualified production property is defined as is non-residential real property that has an integral use in the manufacturing, production, or refining of tangible personal property. So for really only available for manufacturing businesses, they have this short-term opportunity to construct a building or purchase a building and be able to 100% write off the building. And most people, I'm sure, are aware that typically you have to depreciate a building over 39 years. So a benefit that has been spread out for 39 years, you could take that as a write-off all in 1 year, which I've never seen that. I don't think that's ever been done before in the tax code. And so again, it has to be used in a manufacturing process. It excludes areas of the building that aren't used for manufacturing. So, there will still be like a cost seg need to kind of look at the areas of the building, and you'd have to exclude offices, parking, certain parking, lodging, software development, like areas of the building that are being used for those types of activities. The building has to be the original use of that building has to commence with the taxpayer that's taking the write-off. And so it can't be a building, a pre-existing building that someone else has used that you're purchasing. It has to be a new building that's being used for the first time by that taxpayer. It cannot be leased. And then one of the biggest hurdles that I think we're trying to see how people are going to work through is that the taxpayer taking the write-off has to own the building, which means if the manufacturing entity is an S corporation or is a C corporation, that entity would have to own the building. And I think a lot of people a lot of businesses tend to hold their real estate in separate legal entities, and so that's something that we're waiting to see when the regulations are issued on this provision, if there will be something in there allowing related parties, 100% owned or common ownership, separate entities to still be able to take advantage of this opportunity. We don't know the answer to that yet, unfortunately. But I think it's a big opportunity and definitely worth exploring.
Great. So it sounds like more to come on that, and maybe a 2.0 webinar will be needed.
Yeah, so far all we have is the code. And so, with all of these, we have to wait for the IRS to come out and give us the more detailed regulations on how to do things.
Great. Okay, so more on that, folks, when we get to it. Okay, so Bob, let's move it over to you. Some manufacturers were going back into the R&D. So some incur R&D expenses when modifying or relocating their warehouses. So was the R&D tax credit impacted by any of the tax law changes in the bill? And can businesses still claim the R&D tax credit alongside deductions for these expenses?
Sure. Yeah, so the R&D credit, there really weren't any changes to the R&D credit as part of One Big Beautiful Bill. But there were some changes that impacted the R&D credit. So for example, earlier I talked about qualified small businesses that can make the retroactive election to deduct domestic R&D costs currently. In many cases, those taxpayers may have made claim what we call the gross credit versus the reduced R&D credit. And under the new law and a Rev Proc that was issued 2025-28, taxpayers are allowed to go back and retroactively change that method. So if you had claimed the gross credit in 2022, you're allowed to go back and retroactively change that to the reduced credit if that's what is more beneficial. So that's one change. The other change that I expect to see prospectively is, prior to the capitalization requirement beginning in 2022 under the TCJA, I would say that most taxpayers that claim the R&D credit would claim the reduced credit. And they would claim the reduced credit so they wouldn't have to make an adjustment or a reduction to their R&D expenses. During the years where capitalization was required, I would say most taxpayers claimed the full credit. But I expect that 2025 forward, now that we have current expensing back of R&D, I expect that most taxpayers are probably going to go back to claiming or electing the reduced credit. So yeah, and then in terms of R&D credit opportunities, for things such as let's say a company that puts into place a new warehouse, right? Well, as part of that, there could be robotics, there could be machinery and equipment, and there could be customization and modifications to that machinery and equipment. There could be software development activities, software to create AI or use AI, as Peter was talking about earlier. So there are opportunities there and costs that are potentially being incurred that could be eligible for the R&D credit. And the great thing is that beginning in 2025, taxpayers can claim the R&D credit, right, and get the current deduction for those domestic R&D costs, right? They still have to capitalize and amortize those foreign R&D costs, but they get the double benefit of deducting of the R&D credit, which is an offset against their tax liability, as well as the current deduction for those domestic R&D costs versus a reduction to their taxable income.
Great, thank you.
Best of both worlds.
Yeah, I appreciate you laying out all the different things that could be under that R&D tax credit too, because there's so many sort of different ways to use it. So appreciate you giving that overview. So we're running up on time. So Pete, I think you're going to have the final word. We're going to go back to your sort of technology expertise. From a technology standpoint, when leadership teams are designing a new warehouse, what should they be thinking about in terms of digital transformation?
Sure. Yeah, there's lots to think about. My first always basic is making sure that it's networked appropriately, right? So ensuring that it's got great wireless coverage, that your tools, your tablets, your barcode scanners, everything can work throughout the warehouse. You'd be surprised that of finding that out towards the end of a project is not fun, but always can be addressed. I think that's one aspect. As you think about designing a warehouse, it's thinking about the equipment that's going in it. And what that equipment can bring to you from a connectivity perspective, right? So as you look at your forklifts, your conveyors, your other equipment, is it capable of connecting, as part of the Internet of Things to provide health monitoring of that equipment, identifying when it's going to be needing maintenance, so predictive maintenance, and really helping you sort of optimize the usage of that equipment. From a physical layout standpoint, I always think about, how you're laying out the warehouse itself, how the warehouse could change in the future as technology continues to evolve, right? And as we think about some more automated functionality, automated order pickers, or also known as automated storage and retrieval systems. But more importantly, I think at the basics is optimizing your order picking, right? So making sure that the warehouse layout is in a way that It allows for order picking to happen efficiently and effectively, and can also be leveraged with technology to optimize those routes. From a technology standpoint, when we think about ERP systems, a lot of times moving into a new warehouse means a lot of changes to your ERP system. And so we've seen a lot of cases where a company's been moving along on an older ERP system that supported them, maybe doesn't meet all of their needs, but otherwise has done well. But when it comes to realizing that they need to expand the system to support this additional warehouse space and the additional products that they may be offering, there's quite a bit of effort there to bring those systems up to speed. So a lot of times there's a conversation there of, is this a good time for me to move off of my old ERP system and onto a new one? And it's certainly worth looking at. We've seen many cases where we've moved, organizations from a different, like an old mill style warehouse to a more modern warehouse, and the picking and not only the picking, but also the storing of goods is very different. Right. And so those systems need to be able to know how that warehouse is laid out, where things are when it comes to doing the pick, pack, ship operations and making that optimized. So that oftentimes is a consideration there. And it takes time to make those improvements to your ERP system or go out and buy one and implement it. So those are a consideration I would have as well.
Great. Thank you so much. Appreciate it. Whew. That was a lot of information. So I really appreciate all three of you being here and going over that with us. I can imagine folks will have additional questions as a follow-up. If anyone on the webinar has questions, feel free to reach out to the AIM team and we'll make sure you get connected to the answer. But with that, we're coming up perfectly at time. And so to close us out, I'd like to pass it back to Leslie for the final words.
Yeah, thank you, Sarah. I want to thank Bob, Laura, and Pete and Citrin Cooperman for bringing us their expertise here to AIM to help our manufacturing community this morning. Clearly, just scratch the surface of these topics, and I hope all our manufacturers will come away with a couple new areas to explore, which might expand opportunities for their company. We learned how we now have more options under the tax bill, a permanent extension of the 20% pass-through deduction, return to full expensing for the domestic R&D costs. We heard how to start your AI journey within your manufacturing company, not to take away employee jobs, but to maybe give them an assist in their daily functions. Finally, heard about new rules that may increase your opportunity to invest in certain manufacturing warehousing facilities. So if you're still champing at the bit for more information on these topics, as Sarah said, please join AIM's manufacturing community and follow our programming. We want to hear from you so we can best serve all of our colleagues. And thank you to everyone who attended. I, along with my co-chair, Mike Keneally, wish you the best with your companies as we close out this year and hope to see you at our next event. Have a great day, and thank you, everybody, for attending. Bye.